All right, welcome everyone. If you're tired of investing like you're in a rowboat, always looking backward at what already happened, then you are in exactly the right place. Today, we're going to grab the tiller of a sailboat. We're going to look forward and harness the winds of innovation. So yeah, think of this as your masterclass in rule breaker investing.
Okay, let's just dive right in by tearing up the oldest cliche in the book. We're always told, buy low, sell high. But what if that advice is the very thing that's holding you back? Well, we're here today to break the rules that have been costing investors for decades.
So here's the plan. We're going to rebuild your entire investment philosophy around four kind of critical pillars. First, we'll talk about the surprising math of how you can win by losing. Then, the absolute key habit of feeding your winners. Third, why hearing the word overvalued should be music to your ears. And finally, how to build a portfolio that's actually a bet on the future, not just some museum of the past.
So let's kick things off with a huge foundational myth. The idea that your success as an investor is all about your winning percentage. What if I told you that being right only half the time, or heck, even less, could still make you wildly wealthy?
Think about it this way. Investing, it's not like figure skating, right? Where one little mistake, one fall, and your score is ruined. No, it's much more like baseball. Babe Ruth was the home run king, but you know what? He was also the strikeout king. In investing, strikeouts are just minor setbacks, but one big home run, that can win you the whole game and then some.
And that right there, that illustrates the core mathematical truth. See, the most you can possibly lose on any single stock is 100%. That's it. It goes to zero. But the upside, well, it's infinite. Your gains on one massive winner can literally, mathematically, erase the losses from dozens and dozens of strikeouts. It's all about this beautiful, powerful asymmetry.
And if you're not quite convinced how counterintuitive this is, check out this poll The Motley Fool ran on Twitter. They asked people what they'd rather have: a 10-bagger, that's a stock that goes up 10 times, along with a 70% loser, or two solid 40% winners. The result? It was basically a dead heat. That just shows you how deeply our fear of losing is wired into us.
Okay, so let's actually do the math on those two options. Let's say you invested $2,000 in each stock. The quote-unquote safe choice, the two 40% winners, that gives you $5,600. Not bad. But the rule breaker option, that 10x home run and the 70% strikeout, that leaves you with over $20,000. It's not even close. See, the magnitude of your wins is what truly, truly matters.
All right, so that leads us right into our second pillar, and you'll see how this all connects. This is about fighting one of the most common and most costly psychological mistakes that investors make, that temptation to buy the dip on your losing stocks.
We do this because of something called the sunk cost fallacy. We just feel this intense, gut-wrenching urge to get our money back, to get back to even. So we throw good money after bad, trying to fix a mistake, when really we should be focused on what's working.
The rule breaker habit flips this whole thing completely on its head. You add up. That means you add new money, fresh capital, to the stocks that are already winning for you. And you do not double down on your losers. Because as it turns out, winners, well, they just tend to keep on winning. It's a classic saying for a reason. So many investors get nervous, they sell their winners to lock in some little gain, and then they pour that money right into their losers. They are literally cutting their beautiful flowers and then diligently watering the weeds. The key here, the most crucial point, is you have to do the exact opposite. Nurture your growth, and when you do this consistently over many years, something really magical can happen. It's called a spiffy pop. This is when one of your winners, a stock you bought for, say, $50 a share, jumps more than $50 in a single day. It is the ultimate reward for just letting your winners run.
Okay, now for pillar number 3. And this is where we really start breaking Wall Street's rules. This one challenges the entire idea of fair value and that obsession with traditional valuation stuff.
So forget about price-to-earnings ratios for a minute. Just ask yourself this really simple question about a company. David Gardner calls it the snap test. If you snapped your fingers and that company just vanished, who would miss it? The more people who would desperately, truly care, the more powerful and resilient that business actually is.
Now, let's take that a step further. A company that passes the snap test? That's great. But a company that is also the only one doing what it does, with no clear Pepsi to its Coke, well, that's a snap cola. These are the truly dominant, category-defining innovators that end up creating generational wealth. So why does Wall Street miss these companies so often? It's because traditional analysis is totally obsessed with what it can measure, things like earnings and cash flow. But there are no numbers for a visionary culture, or for a beloved brand, or for the sheer potential of future innovations. The most important assets? They're often unquantifiable.
And that's exactly why, for a rule breaker, hearing a stock called overvalued is often the ultimate buy signal. Really, it's basically a confirmation that the market is using old maps to try and navigate a new world. They're busy counting the beans, but they're missing all the magic. All right, let's move on to our final section and see how this all comes together right in your portfolio. This is about shifting your mindset away from just owning a collection of assets to making a really clear statement about the future that you believe in.
You see, traditional investing often looks for certainty. Companies with a single, predictable future, like Coca-Cola selling beverages. It's understandable. But rule breakers, we look for companies with multiple futures. Think of a company like Alphabet. It started in search, sure, but now it has ventures in AI and autonomous driving and healthcare. That's optionality, and it creates this massive, incredible potential.
So, what does a rule breaker portfolio actually look like? Well, it's not just some random basket of stocks. It's a real reflection of your best vision for the world. It's got to be optimistic. It's filled with the top dogs and the innovators who are out there actively building that better future.
This quote from Kevin Kelly just captures the whole spirit of it perfectly. You are investing in companies that aren't just executing on one plan. No, they are constantly creating new pathways for growth, new opportunities to win, and brand new ways to change the world.
So, this brings us to the most important question you can ask yourself as an investor. I want you to look at your own portfolio right now. Is it a backward-looking collection of yesterday's winners? Is it basically a museum of what used to work? Or is it a bold, an optimistic, and an intentional bet on the future you want to see? The choice, and of course the rewards, are all yours.